Traditional's modern accounting terms, what every accounting professional should know. Hello everyone, and welcome back to the channel. Accounting is often called the language of business. While the fundamental principles of accounting remain largely unchanged, the way we communicate those principles has evolved significantly over time. As businesses become more global, technology continues to advance, and accounting standards evolve, many traditional accounting terms have been replaced, updated, or supplemented by modern terminology. For accounting professionals, students, auditors, finance managers, and business leaders, understanding both traditional and modern accounting terms is essential for effective communication in today's workplace. In today's video, we'll discuss why accounting terminology evolves, traditional accounting terms and their modern equivalents, how technology and accounting standards influence terminology, why professionals must understand both old and new terms, real-world examples from modern accounting practice. Let's get started. Why accounting terminology changes. Accounting fundamentals are built on centuries-old principles. The concepts of assets, liabilities, equity, revenue, expenses remain the foundation of accounting today. However, businesses now operate in a much different environment than they did 20 or 30 years ago. Several factors drive changes in accounting terminology. Global accounting standards. Organizations increasingly follow international frameworks such as IFRS and GAAP. As standards change, terminology must become more consistent across countries. Technology and automation. Cloud accounting platforms, ERP systems, AI-powered analytics, and digital reporting have introduced entirely new accounting terms. Business complexity. Modern business models involve e-commerce, digital asset subscription revenues as businesses cryptocurrency transactions. These require updated language and reporting methods. As accounting evolves, professionals must adapt without losing sight of the core principles. Traditional's modern accounting terms. Debtors, accounts receivable. Traditionally, businesses used the term debtors. Today, the more common term is accounts receivable. Both refer to money owed to a business by customers for goods or services sold on credit. Example: if a customer purchases products worth $5 and pays later, that amount becomes an accounts receivable. Modern accounting software generally uses the term accounts receivable instead of debtors. Creditors, accounts payable. Another traditional term is creditors. Today, most organizations use accounts payable. This represents amounts owed to suppliers and vendors. Example: a company purchases raw materials on credit. Until payment is made, the amount remains in accounts payable. The meaning remains unchanged. Only the terminology has become more standardized. Stock inventory. In traditional accounting, businesses often refer to goods held for sale as stock. Modern accounting frequently uses the term inventory. Inventory includes raw materials, work in progress, finished goods. ERP systems such as SAP and Oracle almost always use inventory in their reporting modules. Fixed assets, property, plant and equipment, PPE. Historically, accountants used the term fixed assets. Modern financial statements under IFRS commonly refer to these assets as property, plant and equipment, P. Examples include buildings, machinery, vehicles, furniture, equipment. The concept remains the same. The terminology simply became more specific. Profit and loss account, income statement. Many experienced accountants still use the phrase profit and loss account or PL. Today's accounting standards typically use income statement or statement of profit or loss. The purpose remains identical: to measure the organization's performance over a period. Troy, balance sheet statement of financial position. Traditionally, balance sheet. Modern IFRS terminology. Statement of financial position. This statement shows assets, liabilities, equity at a specific date. Many professionals still use both terms interchangeably. SHATA, cash book, cash management system. In manual accounting systems, accountants maintain a cash book. Today, organizations typically use treasury systems, cash management modules, or based cash reporting. Technology has changed the tools, but not the objective of tracking cash transactions. Art, bookkeeper, accounting specialist. Historically, bookkeepers manually record transactions. Today, organizations often use titles such as accounting specialist, finance associate, accounting analyst. While responsibilities may differ slightly, the core focus remains maintaining accurate financial records. Manual ledger, digital ledger. Traditional accounting relied on physical ledgers. Today's businesses use SAP, Oracle Dynamics 365 QuickBooks Zero. Transactions are now recorded electronically. However, the concept of the ledger remains fundamental. Trial balance, financial data validation. The trial balance still exists today. However, many organizations use broader terminology such as data validation, financial reconciliation, period, and review. Technology has automated many tasks previously performed manually. The impact of digital transformation. Accounting has undergone massive digital transformation. Modern professionals regularly use terms such as ERP, enterprise resource planning systems that integrate accounting, procurement, inventory, and operations. Automation. Software automatically processing invoices, reconciliations, and reporting. Cloud accounting. Financial data stored and accessed securely online. Analytics. Using data to generate business insights. Dashboard reporting. Visual reports displaying key financial metrics in real time. While these terms may seem new, they are simply modern tools supporting traditional accounting objectives. The fundamental principles have not changed. Why accountants must understand both. Successful accounting professionals understand both traditional and modern terminology. Why? Because today's workplace contains multiple generations of professionals. You may work with senior accountants using traditional terms, auditors using regulatory terminology, or consultants using technology-focused language, international teams using IFRS terminology. Understanding all forms of accounting language improves communication, collaboration, reporting accuracy, career growth, professional credibility. The best accounting professionals can easily translate between traditional and modern terminology. Conclusion. Let's recap today's discussion. Accounting continues to evolve with technology, globalization, and changing standards. However, the fundamental principles remain unchanged. Some common examples include debtors' accounts receivable, creditors' accounts payable, stock inventory, fixed assets, property, plant and equipment, profit loss account, income statement, balance sheet, statement of financial position, manual ledger, digital ledger. While the terminology evolves, the purpose of accounting remains the same: to provide accurate, reliable, and meaningful financial information for decision-making. As accounting professionals, embracing modern terminology while understanding traditional concepts will help us remain effective in an ever-changing business environment. If you found this video helpful, like this video, subscribe to the channel, share it with your colleagues, and in the comments below, tell us, which traditional accounting term do you still use most often in your workplace? Thank you for watching, and I'll see you in the next accounting and finance tutorial.